So Nav, you're first. Who are you?
Who am I? My name's Nav Athwal. I am enjoying this beautiful view, great venue. I am the CEO and founder of Realty Shares. Realty Shares is an online marketplace or crowdfunding platform for real estate. We have been around for about 2.5 years. In that time frame, have funded about $200 million capital through the platform. Focus on both debt and equity and commercial and resi investment properties. We are based in San Francisco, but I always like being in Southern California when I can for the weather. And it's great to be here today.
I've never had a view like this. This is awesome. I am Richard Swart, and I have a lot of titles, and I want to try to skip to the part that might be possibly relevant. The badge says UC Berkeley. I'm actually transitioning away from UC Berkeley. Sorry, Nav, because he's a Berkeley alum. So I'm sort of the data geek of crowdfunding. There's no analyst Forrester, doesn't follow the industry. There's not enough money, frankly, yet for anybody to follow it and dedicate resources to having an analyst shop. So as an academic, I've been doing most of that work. For the last 3 years at UC Berkeley, I've been running the research team in Haas, studying crowdfunding, alternative finance, and sort of the intersection of impact investing, social-based investing models, and crowdfunding models. I'm a recovering relapsed or relapsed recovering academic, so I've actually come in and out 3 times. I've had a couple of exits as an entrepreneur. I've run companies. I've been with a venture firm before. So I can't quite decide what I'm going to do when I grow up, so I just keep doing things. This fall, I'm actually going to be part of Stanford's Technology Venture Program, getting my hands a little dirty at Stanford. But a lot of what Jillian and I go back from the very beginnings of this industry is that I've been doing a lot of the initial fundamental research, market growth, market size, what's happening globally. I wrote the World Bank report on crowdfunding, the UK alternative assets reports. I've consulted with 7 national governments on crowdfunding regulations. So, in fact, I'm leaving here today to go to Washington, D.C. to go yell at regulators. So I spent a lot of time, too much time, in fact, in Washington, D.C. dealing with regulatory threats. And I've worked with the White House, SEC, Congress, FINRA, other assorted groups. And at some point today, we'll talk about my phone call with Treasury that happened last week, which sent shivers down my back. Ooh.
Richard, you said you're going to go yell at regulators. Which regulators are you going to yell at and why?
This particular group is NASA, the combination of the 50 state regulators plus the Canadian provincial regulators. I'll give you a funny story. So I was keynoting at another conference a few months ago, and I said the number 1 threat to the industry is state regulators, not the federal regulators. After my speech, 3 state regulators came onto the stage. I didn't look at the agenda before I spoke, apparently. And 2 of the 3 said it under 506, Reg CF, sorry, use the right terminology now. Under Reg CF, you had to register your offering with their states. So Doug Ellenoff, one of the other attorneys in the crowd, pulls out the regs and says, by the way, you're specifically exempted from state level registration. You're absolutely wrong. So think about it. The state regulator is keynoting a major conference in the industry and isn't even familiar with the regulations that they're regulating. What does that tell us about their opinion of the industry? The sad fact is they have deep contempt for non-accredited crowdfunding. And there's a lot of pressure and a lot of discussion still occurring within the state regulators to try to sabotage crowdfunding. So when I say go yell at, since I don't know, I'm not an operator, I'm not a sponsor, I'm not a broker, I get to be objective, which means I get to be really rude, because they don't regulate.
Now, I have a question for you.
Sure.
Because Realty Shares happens to be one of my favoriteest platforms.
Awesome.
So what do you look for the issuers who are in the room, and I know there's a few, what do you look for from an issuer before you'll even think about accepting them for the Realty Shares platform?
Sure. So just to put things in perspective, each month we're probably getting about 1,200 applications, 1,200 to 1,400 applications from issuers around the U.S. Some are legitimate applications, some are half filled out, but that's the world of applications we're receiving. Wow. So there's a big universe of issuers out there that want to explore crowdfunding as a way to raise capital. I think the number 1 thing we look for when we see an application is what is the prior track record? How long have you been in business? How many deals have you executed in the past? Are you a first-time real estate investor and operator? Is this your 10th deal? So really track record guides pretty much every decision we make on whether we want to work with a specific operator or fund a specific deal. once we get comfortable with the track record, we will do just standard background credit checks on the issuer and any key principles of the issuer to just make sure there's no major criminal issues or major financial issues that have been historically on their record. And then we really get into the deal. So I think we have a very flexible platform. When we started the company 2.5, 3 years ago, our number one objective was we want to make the process of raising capital more efficient. We want to bring investors that would otherwise not have access to deal flow in multiple markets to these real estate operators, but we don't want to necessarily change the way they do business. We don't want to create new structures that make it difficult for them to operate the deal or manage the investors. We really want to fit within the existing ecosystem and the existing way that they do business. So when we get into the deal, we look for, we look at the financial model, we look at an appraisal, et cetera, we're really looking to see if the returns meet the objectives of our investors. And then we work with the operator to really structure the deal in a way that works for them. So it's through an LLC syndicate. All of our investors come in as one LLC, so you're not adding another 40 investors to your own LLC. One investor managed by our affiliate. But again, going back to your question, I think what we really look for is track record, and then we get into the deal and look at the returns and the assumptions around the returns and whether they fit the over 30,000 accredited investors we have on the platform.
Now, Richard brought up states and the problems with states not being very cozy with crowdfunding or really taking the time to even learn the law. And my experiences with the states is sometimes they don't even learn their own laws. So, and I'm not saying that in a derogatory manner, it's true. They got a lot of stuff these regulators who are attorneys at the state level are a lot of times worried about a lot of securities fraud and a lot of fraud and not just, real estate crowdfunding, for example. So their brain, like all of us, can only fit so much information. And so and when they see something that looks like fraud, they immediately believe it's fraud. They don't investigate. It's kind of the whole shoot first, ask questions later mentality. Nav, with your platform, what have you run into with the state regulators, if any problems at all?
I mean, state regulators, I think the problem with the way the state regulators are thinking about this is there's been a shift of power through the Jobs Act between state and federal. Reg A was not preempted. Reg A Plus does preempt state law. You have this new preempted regulation called Regulation CF. So states are slowly feeling like they're losing power.
Well, they lost their battle too.
Yeah, exactly. So I think that in turn has created some level of, okay, we need to really get our pulse on this and even interject ourselves because we're losing power to oversee this in a much bigger way. Regulation D, Rule 506, unfortunately, has preempted state law since inception. So we use Reg D Rule 506, and we haven't used Reg A Plus yet, where we haven't started the path down using the crowdfund exemption. So I think states have been sort of hands-off with our platform because we are using a regulation that has preempted state law for decades. But I do think states just generally are paying attention, and I think the difficulty is every state's so different. Some states are very forward-thinking, and some states even passed their own versions of a crowdfund exemption prior to Title III going into effect in May. So I think some are very forward-looking, want it to be easier to do business, raise capital, and others just don't. So I think it's very different. We haven't had any big run-ins with states. We've definitely had inquiries on, hey, how's your business work? We see that you're selling securities to investors in our state. Can you tell us more? But it's only been inquiries. It hasn't been anything more. But I do think every state's very different.
Mm-hmm. Richard, if I was an investor and I'm investing for the first time, what should I be looking for?
So really in real estate specifically?
Or just in a crowdfunding platform and specifically?
Well, several things. First of all, 99% of people in America wouldn't even understand what you're talking about. So we need to recognize that the vast majority of investors, well, the vast majority of Americans don't invest, period, end of story. Those that do, the vast majority do through their work through 401ks. They have no idea what those portfolios contain. They don't read the disclosures. They don't read the prospectuses. A very small number of people actually have any idea what they're invested in.
Mm-hmm.
So if you take the very small subset of people that actually do self-directed IRAs and some active investing, there's several things we need to look at. First of all, there's the myth that crowdfunding implies it's all sexy tech and web companies, and this is the next Facebook. So aside from the online begging, the opposite is people thinking that the nature of technology-based industry implies that all the companies have to be highly stable, great growth expectations. I get fan calls you do from China all the time, and they're looking for 20 to 30% annual yields net of everything. And I'm like, well, that'd be nice. Tell me where to find those deals consistently, and I'll invest alongside of you. But there's a perception that crowdfunding is new and sexy in some quarters, and all it really is a shift in securities regulations which allow new types of deal structures to be enacted, and the general solicitation is probably the most interesting part of crowdfunding, in my opinion. But there's nothing about the nature of a deal crowdfunded versus done through a traditional sponsor or broker-dealer network that makes it better or worse. So you still have to look at deal fundamentals, so look at the financial returns, history of the operators. And I think people lose that awareness. What we have found, which is really interesting, I always like to make this point, is crowdfunding was not invented here in the US. In fact, we're one of the last countries to join the party. Crowdfunding has been operating in Australia for equity crowdfunding for 14 years now. It's been in the EU for about 7 years. So America is actually a laggard. And our securities regulations are onerous, difficult, and otherwise reflective of Washington, D.C. right now. But the point being that we didn't do it well, we didn't do it elegantly, we didn't do it easily. So the data from Europe shows that crowdfunding investors typically skip over all the financials. They literally ignore all the financial disclosures, and they literally don't even look at them. If you look at the web traffic data of where they go on websites and what they look at is the market opportunity, and then they look at the management team and they look at their experience, and they try to do like a basically market fit or a management market acumen assessment and try to determine if they believe that these people have the ability to execute in this market or not. And they don't spend a lot of time because, as a former VC, we all know the projections are a bunch of crap. We know the 5-year hockey stick doesn't exist, and a smart VC uses the ability of an issuer to describe how they're going to make money, and if they understand the financials and the underlying fundamentals of their business as a proxy for how smart the management team is. We don't assume that those numbers actually mean anything. It's the dance you all do, right? Well, I think sophisticated real estate investors have your own version of that dance, and I'm not a real estate guy, so I'm not going to pretend to be able to use the analogies. But equity crowdfunding investors typically zero in on who you are and what your experience has been, as opposed to giving some macro level economic projections about growth in the industry.
So Nav, when you're putting something on your platform, how do you, with hearing what Richard said, how do you position something onto your platform to make it palatable to the investor while still making the proper disclosure?
Yeah, I mean, I think that's one difficult thing to balance because ultimately when you're building a tech company and you're building a product, you want to make it seamless. You want to make it streamlined. You want to make it easy to understand so that an investor can come on, make a quick decision, and ultimately go through a very easy investment process. But obviously when you're selling securities, you're also regulated, and there's the need to make sure you're fully disclosing all the information that is necessary to disclose. So we've always taken the approach that disclosure is key, and there's ways to create disclosure that aren't overly burdensome to our investor base. We have, I think, just to kind of elaborate on what Richard was saying, the investors using crowdfunding are very different. Not all of them are come from one typical industry or one type of profession. We have investors, again, over 30,000 accredited investors that come from all walks of life, all age groups, all professions. We have doctors, we have finance professionals, we have sophisticated real estate investors. So each investor, I think, views an investment differently. And I mentioned earlier, you asked, what do you look for in a deal? And I said track record of the operator is probably the number one most important thing. And that I think is very consistent. What Richard was saying is the management team and their ability to execute. Is that something that the investor can believe in? So I think the way we balance it is on the deal pages, so that's the pages that investors see when a deal goes live and actually make decisions based on that page. We try to disclose all the information we can in a very easy to read format, but then we have a documents tab where all the backup information is there. So if an investor really wanted to dig in more deeply, they could go in, download PDFs, download Excel docs, and plug and chug into those models and get a little bit more granular with the deal. But if an investor got comfortable with the deal without doing that, they could just look at the deal page and make that decision. And then if you look at our deal pages, every deal page has a very long list of disclosures where we make clear that, look, we've done our diligence, we've vetted these deals, but there's risk. So I think it's gone really well. I think this entire industry is about transparency. I think you made a really good point, Jillian, is we're all gatekeepers of this industry, and it's really important that we treat it properly, so we avoid what happened after the Madoff scandal. And I think most platforms out there are taking that seriously because they know it's their business, and one platform could impact the entire industry. And so our investors generally have been very happy with the transparency. As we've grown, we've tried to make it a bigger point to create transparency, education, and be more balanced than just saying, hey, this is a great deal, you should buy it. Hey, this is a deal we've vetted, and here's all the things we like about it, but here's the things that are not so great that could happen if you invest in it.
Absolutely. Now, this question's for both of you. Now, I made it very clear how I feel about Regulation A and Reg CF. I think Reg CF personally is a little, it doesn't make sense to me in the long run from an issuer perspective. But I'd like to hear from both of you guys on the perspective from the investor and from the platform or an issuer perspective or an educated man's perspective on should we be allowing unaccredited investors to carte blanche invest in these platforms? Richard, we'll start with you.
Since you talk to regulators pretty much every week, I think you're probably best equipped to take the first.
Yeah, I actually chaired the Securities and Exchange Commission's Investor Protection Panel for Title III for academic, so I spent many an hour with the SEC on this. I think the regulations are ridiculously overly burdensome from the issuer's perspective. That being said, the SEC really...
Oh, come on, I need a job.
I love lawyers, but let's be real. The Congress, okay, the little sausage making, I'm going to give you a 30-second history of the Jobs Act. The bill that passed out of Congress originally was clean, allowed SPVs, allowed a $5 million cap, not a $1 million cap for Reg CF. It did not have a huge amount of compliance and ongoing reporting requirements. It then got bounced to the Senate Banking and the Senate Small Business Committee that then got involved in some vote trading around the XM bill, which had nothing to do with the Jobs Act. The version that came out had like 14 regulations slapped on top of it thanks to Elizabeth Warren and her camp. And so the stuff that is in the Jobs Act that we don't like about Reg CF was not informed by policy, analysis, data. It was literally a vote trade. And what? I know. That happens. DC behaves like politicians. I know. So I'm being a little cynical, but no, the point being that the version that came out of the House was actually informed by a fairly good understanding of the behavior of issuers. The version that came out of the Senate was informed by Elizabeth Warren. You can tell I'm not.
How do you feel about Elizabeth Warren?
I'm actually a Democrat, but on certain issues you have to have a little sanity too. So I think she's a little bit over the top, let's just say. Now, this is an interesting situation. Most people in crowdfunding in the industry probably lean far left politically, but our main proponents in Congress have been the Tea Party. So you have East Coast and West Coast tech entrepreneurs partner with the Tea Party against the Democrats. So welcome to DC. The reality is the platform risk, there's some issues, some language about liability of the platforms in Reg CF, which I think is very dangerous, and I argued strongly against that, and we lost that argument. I think the ongoing reporting is ridiculous, that you have a lifetime reporting as long as you have a single investor in your cap table, you have about a $5,000 to $7,000 a year, thank you lawyers, compliance costs that has to be borne, and I'm sure that eventually people will systematize that down, but your total cost of capital under Reg CF is incredibly burdensome. So I see it as being more of a strategic activity that a small issuer may use to mobilize support and be part of a larger cap raise, but I don't see a huge potential. Now there's a bill right now before Congress. Last week it was in committee. There's a compromise, so they're going to not allow 5 million, that we lost that fight, but they are going to allow SPVs if this gets through Congress. Now, how many industry that Congress will actually vote a bill through before the election? Exactly. So there's a bill, there's a committee compromise going on to fix a lot of these things, but I don't think there's any chance of anything will get to Congress, period. I think Reg A and Reg A Plus are much more elegant and intelligent and more rationally fashioned, and they have a huge potential, and we've already seen criminal solicitation dramatically affect the behavior of angel investors. And I work with Angel Capital Association as well, so there's a lot of great things in the Jobs Act. I think Reg CF is probably not one of those things.
Interesting. Now, Nav, if you did, I did the quick math. You said you had 30,000 accredited investors now. So if you opened those doors and did, ran it against the general population, that means that you should increase your investor base to about $1 million people rather. Is that something you'd want to do, and why or why not?
I mean, when we first started the platform, the mission and vision was to make real estate accessible to the general public. I'm a former lawyer, don't hold that against me, but I was naive.
Too late. Go on.
Naive in realizing that that's actually not very easy to do. So, we started this very limited mission of we're going to make real estate investing accessible to accredited investors who still have difficulty accessing private real estate investments, because you don't need to be Warren Buffett to be accredited. You just need 200,000 of income or $1 million of net worth. I mean, it's something we've always thought about. I agree with what Richard is saying. It opens up a can of worms with respect to regulators. Jillian, you made a really good point that regulators are, actually streamlining Reg A approvals, but what are they thinking after that? How are they their just oversight over that offering is just going to be a lot more, because you are opening the floodgates. So for us, we definitely are entertaining the possibility of opening up the platform to non-accredited investors. I think weekly we get an email from an angry non-accredited investor telling us that we're, artificially creating limitations on their ability to invest, the rich are getting richer. Like, we hear that all the time. And I'm on every single customer support email because I still want to hear what people are saying, so I get those directly in my inbox. So there's a lot of sophisticated investors out there that are not accredited, that understand real estate, but that are artificially told due to regulation that they can't get involved. And now there's Reg A Plus and there's Regulation CF, and I agree that Regulation CF is just not workable. I'll go on record in saying that Regulation CF will never work for real estate crowdfunding in its current form. I think Reg A Plus is a lot more manageable. So I think for us, it's cautious optimism, really watching the first few iterations of Reg A Plus, how it takes shape. I think our business is growing very nicely with just accredited investors. We're funding anywhere from 17 to 19 million of capital a month, and it's been growing nicely and we're adding institutional capital. So the business is not in jeopardy by not opening the gate to non-accredited investors, but the mission is only partially realized if we don't. So I think it's something we will continue to consider, but we're not ready to take that step just yet.
You'll be happy to know we're lobbying for what's called the underlying asset exemption to fix Title III, to recognize the fact, because Title III assumes you're a startup with no assets. You're basically, so where we actually have an asset in a real estate deal, we're arguing to change Reg CF, like the 2018 version of the bill, to actually make a substantial number, the $5 million cap, and decrease the reporting and decrease the compliance.
I have a question for you on that.
Sure.
So I think one thing that makes Reg CF, and tell me if I'm wrong because I haven't followed it as much, is it limits an issuer's ability to raise capital on an annual basis. And for our platform, we create an SPV per deal.
Yeah.
So we are the issuer. So we'll blow that out in one deal. So if you aggregate all of our SPVs, all of those SPVs are definitely exceeding that $1 million. How would that, have you talked to, I know you're talking to regulators weekly. Right. Is that on their radar? Is that something that could change? I think it would make it more workable.
They're talking about allowing SPVs. That's probably
That's great.
So when you say that it's an asset-backed security, does it have to be a note secured by a deed of trust or mortgage, or can it be an equity investment in an LLC that only has, can it be an SPV?
under the current discussion as of a week ago, it can be an SPV.
Oh, that's
2
awesome.
weeks ago, the answer would have been it cannot be an SPV.
So I just want to clarify for those of you that might be sitting there scratching your head, as SPV is a special purpose vehicle which would only own one asset, and then you could sell interests in that particular entity, whether it be preferred equity, or some kind of debt, and as opposed to an asset-backed security like a note with a mortgage or a deed of trust behind it. I mean, I find that very encouraging, personally, especially for some of the other, the platforms out there, patch of land, ground floor, that operate on that model. I mean, that would blow their particular business up, right?
I think you'd see a dramatic increase in the entire industry if that gets through.
Mm-hmm.
Now, the fact that there's a compromise that's been fashioned between the Democrats and the Republicans of the House, and they've agreed on this, doesn't mean we know what's going to happen when it hits the Senate. But it's looking like that might actually get through.
So you said something earlier, though, Richard, that I want to harp on a little bit, is that you said, I said something, you said 99% of the people you talk to wouldn't understand that.
99% of Americans. Probably.
Americans wouldn't know what I was talking about. But let's talk about real, I don't know if that is a real statistic, but how many do not know what crowdfunding is? How many Americans don't know what crowdfunding is?
Okay, so you want me to get into that. The actual data is that about 87% of Americans are not familiar with crowdfunding. 13% are. That 13% that believe they are probably think it means Kickstarter, and they don't understand the difference between equity crowdfunding. They certainly don't know the difference between the different types of the Jobs Act, and they absolutely don't know about debt versus equity and the actual deal structuring. Out of the 8.7 or 9 million potential accredited investors in the U.S., only 3% of those invest in early-stage companies. So the actual pool of people that might be aware of equity crowdfunding at a deep level is probably less than 500,000 in the U.S.
Wow. So what do we do to change that? Or do we change that? Do
we
keep it a secret?
We do a lot of panels.
You do a lot of panels. Don't you have to get people to said panels, however?
No,
so
one of my many hats is there's a company here in LA called NextGen Crowdfunding, and I'm now advising the founder. He's one of the wealthiest individuals here in LA. And his whole passion is around educating the general public about crowdfunding. So we're doing webinars and events and trying to spread the word about the fact that there's this new industry. But if you look at any change in security regulations, pipes, SPACs, anything that's sort of been a disruptive new model, most securities, new types of vehicles and securities take about a decade for broad acceptance. So for Reg CF, we're in the 5th week of its evolution. For Title Reg A+, we're in the 7th month, I believe. So I still believe we're very, very early, which has a couple of implications. When you've done a great job of acquiring customer acquisition is going to be difficult, and it's not like this is going to explode very quickly.
right.
That being said, this has become normal. And I'm in Europe, we're like, why do you Americans get so freaked out? It's just a different type of asset. It's a different investment vehicle. For some deals it makes sense. Do it when it makes sense. End of discussion. So there's much ado about nothing in terms of fraud. There's very, very little fraud. In the entire world of crowdfunding the last decade, 1,800 platforms in the world, tens of billions of dollars of transaction volume. You can count the number of cases of fraud on a single hand.
Just to add there, and I think Richard kind of hit upon this, we've artificially limited who should know about crowdfunding over the last 3 to 5 years, right? We've told the general public, sorry, you can't participate. It's only these 9 million, and most of those probably don't even invest their own money directly.
Vast majority don't.
So we've artificially limited who should know about crowdfunding, right? If you can't invest and use it, why should you know? So I think the first step is really Reg A+ and other exemptions, whether it be an amended version of Regulation CF, that actually broaden who it can impact beyond just the accredited investors. So I think if it becomes a utility for the general public, then there's a vested interest to know what this utility is. I think the second thing is, if you kind of, Richard, tell me if you have any stats on this, but if you probably bifurcate or split up the public into like the younger, like millennials, I hate that word, but it's used and out there, baby boomers, et cetera. I think there's probably a growing number of millennials and younger people, not about crowdfunding maybe, but about fintech generally, that are paying attention. And so I was going through these stats recently that were put out by Foundation Capital, and it said something like 50% or more of millennials would rather go to the dentist than go to a bank. or a
Oh, no, it's
traditional.
over 90%.
Or it's 90%, some ridiculous amount.
Over
No one
90%.
likes going to the
Yeah,
dentist.
I know that.
You're just, the dentist is not a fun place. So I
It
think.
means I've never been to a dentist, is what it means.
Yeah. So I think there is this growing cynicism towards traditional players, whether it be wealth advisors, broker dealers, banks, et cetera. And so I do think if you sort of split up the public, you'd see the younger population more attuned to what is happening with fintech. And I think crowdfunding is a part of that ecosystem, obviously not the only part. And unfortunately, millennials don't have as much money as baby boomers because they just haven't worked as long, and they're artificially excluded. But I do think as you expand the regulation, who it impacts, and you look at the younger population out there, the potential to really adapt to these new ways of investing and raising capital will start catching on.
So can you take a top-down approach, perhaps? I know that you just made a comment about millennials and going to the bank or brokers or registered investment advisors, but do you think the solution is to educate registered investment advisors, Merrill Lynch's of the world, and perhaps taking it from that angle? Traditionally speaking, a traditional broker is going to fear a private placement memorandum. They won't even look at it. So how do we get them to get their clients, if you will, into the deals or into crowdfunding platforms?
Ask Steve Sadler later when he's on his panel, but the reality is RIAs, BD networks are still extraordinarily uncomfortable with this whole model. They're learning, they're thinking. A lot of individual wealth advisors and broker-dealers actually like it. I'd invite Steve to share his experience later, but there's others as well. You hit the compliance shop inside the BDs, and they're like, absolutely no way, we're not going to touch one of these. So unfortunately, we're at this sort of, no one wants to be the first mover, no one wants to take on that risk. And so as you see deals be successful, as you see positive outcomes, the compliance shops and the BDs will start to relax a little bit, maybe, depending on how FINRA reacts. But I think it's going to take a very long time. I honestly think, and one of the most exciting things to happen in crowdfunding last month was when Mark Cuban talked about Reg A+. And he did a large article on how excited he was about Reg A+. You get a shark out there talking about it. That's honestly what it's going to take, is getting people like Mark, and I know Mark, I know Damon, I know some of the sharks. Honestly, I'm trying to tell those guys, start talking. One of my friends runs a agency that works with NBA stars and tries to help them with their private wealth. And I've said, why don't we do some work around real estate in the cities you come from, using Reg A deals back in Chicago or Detroit or Baltimore, and then talk about real estate crowdfunding as both economic opportunity and community redevelopment, and bring some star power to the table. And honestly, I think you need a few of those. I can't discuss the deal, but there is one of the largest sports in America, it's not the NBA, is looking at using a Reg A deal on a historic property that everyone in this room would know the name of if I was allowed to say it. So let's just pretend it was the football stadium at Berkeley. We were going to sell the stadium to alumni. Then let's do that with something with 100 times bigger audience. So as we start to see deals like this on landmark marquee properties, I think we'll start to see more community awareness. You asked a question earlier, should we allow people to invest? Absolutely, there's some wonderful deals in real estate. I think with the right diversification and the right screening, this is actually a super intelligent way for the average American to invest in income-producing properties. It's relatively low risk. You're not going to become a multimillionaire, but certainly better than your 401k account. But the drivers that I'm seeing, though, are not sort of top down. I work with multifamily offices, like some of the largest in the world, and they're asking questions about real estate crowdfunding, and they're starting to show a lot of interest. But they want to write $50 million checks, $100 million checks. They don't want to write a $200,000 check. So you start to see institutional money of that level expressing interest. Multifamily offices, RIAs, very large investment funds from Asia and Europe are starting to ask about the industry. That's, to me, a really positive sign that in 2 or 3 or 5 years, as people figure out the models, figure out the risk, basically the focus will follow the money. If the money's starting to flow, then that will start to drive awareness. But I think it is going to be very much driven by sophisticated existing networks of investors. I don't think Joe the plumber is going to be showing up anytime soon.
Well, no. And hopefully we can get more information out there on that Facebook thing or Twitter thing or Instagram
there's
thing.
18,000 articles on crowdfunding on the internet today, and probably
How do you know that? That's crazy.
I do research. Sorry. Yeah, of course, Google, you can totally rely on their.
I think he's written half of them, maybe.
A third. Most of it's garbage. I mean, honestly, the number of people it's like social media. How many people do you know in social media that actually consistently drive results and profit to their clients versus self-appointed wizards, mavens, ninjas, and other sort of experts in social media, right? The pool of people that truly know this industry from an expert legal opinion and from an expert compliance would fit in this room, probably.
Yeah, so it's an interesting point there. So we work with a large law firm, DLA Piper. They're one of the biggest in the world. Even some of their lawyers scratch their head because it's uncharted territory, right? I mean, this is just taken shape over the last 5 to 10 years, and so it's very limited in terms of. So I think back to your question, Julian, of like the top-down approach to wealth managers, larger stakeholders, are the gatekeepers. If the lawyers that are advising them don't get it, it's going to be hard to get them going until this is evolved a little bit more. And it's both from a regulatory standpoint, but also from just these platforms have now been around for a decade. They've gone through a cycle. There's performance history. I think the number one things RIAs care about is what's been your performance, and how do I plug into this, and how can I really feel comfortable? Because what's their interest? What's their vested interest in trying to take more risk on behalf of their client? Most RIAs that we've talked to that want to explore this understand that their clients need more from them than just putting money into a mutual fund. They want the RIA to actually add value. Otherwise, they're going to get disrupted by a Betterment or a Wealthfront. So I think it's a ways away to really get to the larger players in the space.
Excellent, excellent. Well, I am getting the wrap it up signal. Oh, questions. Oh, sorry. I thought I was getting the wrap it up signal. Sorry. Who would like to ask a question? Thank you.
That was easy. All right.
Nav, I have a question for you. Out of 30,000 investors, what's your average investment size?
So out of the 30,000 that are registered, about 15% are active, very active. And the average check is around 15,000 per investor.
Oh, wow. It's a pretty good average.
That's pretty good.
I saw a hand over here.
Do you think that Reg A plus is more valuable than Reg CF just because of the limit you can raise?
It's not just I'll answer if you don't mind,
Please, go
gentlemen. It's not just about the limit that you can raise. It's also the restrictions on the issuer and the restrictions on how much they can take from each individual investor. We're talking 5% of somebody's net worth or $2,000 is the most you can take from an individual investor in a deal. $1 million, and you can only advertise it on the crowdfunding platform that you're on. So what good is that? That means you can't put it on Facebook, you can't put it on Twitter. Reg A, you can put anywhere. You can plaster all over the place. You can put a billboard up on the side of the 5 and tell everybody to invest in your deal. You cannot do that under Reg CF. It's highly restrictive.
What is the standard of verifying the net worth?
It's self-certification, which means that the investor is compelled to be honest with you, and you can rely upon that. Unlike 506C, where it is your duty to make sure that they're telling the truth.
So, Nav, I don't remember the specific number, but it seemed like the number of deals that you were presented to you on a monthly basis was pretty significant. So, can you reiterate that number and then tell us how many deals actually make it?
Sure. So the number ranges from 1,200 to 1,400 applications, but as I mentioned, a lot of those are not viable. On a monthly basis, there's probably 20 to 35 transactions that are actually going through the platform. So, and the way it works is not every deal gets listed on the day the month the application comes in. In real estate, there's longer turn times. So we're approving probably 60 to 80 operators a month, but only about 30 to 35 deals, 25 to 35 deals.
That's crazy.
Still good.
Richard, you had another comment?
Well, I just wanted to point out that we're still in the very beginning innings, but I think that like tech, those companies like NAV that have first mover advantage are going to have significant opportunities to scale quickly. And I think there's a lot of analogies to the growth of any network-based business model. Yeah, so a lot of people in the room might be thinking about starting a platform. I'm going to encourage you to really carefully think about that before you take the plunge. It's incredibly difficult to acquire those 30,000 or 50,000. I just wanted to, even though I'm saying the industry is in its infancy, I still think there's significant momentum, and it's very hard to jump in if you haven't already started. So just a word of caution.
A question from a funding perspective, of funding these types of deals. So typically, there's the actual funding source is funding a security that's one step removed from the actual underlying security, and there's some types of bridge, maybe it's a note purchase agreement or something along those lines. Can you talk about some of the strengths and weaknesses of that additional link or that additional step removed from the actual underlying security that the investor is funding? And are there any structures that are preferred or not recommended to be used? Sometimes they're going into bankruptcy remote vehicles and things like that.
I can't speak for your platform, but my experiences as a securities, our firm's done over $1 billion in specifically real estate deals. And it's my experience that the investor does not care. The security interest, what they're receiving, matters very little. It's the asset, the management, and the return on investment. And the question the investors ask, how much money do you need? How are you going to spend my money? How much money am I going to get back? And when am I going to get it back? That's it. Whether it's a note secured by a deed of trust or mortgage, a preferred equity interest, or some kind of equity split is basically irrelevant.
Yeah, I would say for us, the reason why the security issue to our investors is one step removed from the underlying asset security is convenience, cost, and efficiency. Mm-hmm. So if we had investors, there's a lot of real estate operators in this room, I assume. But if you had 10 check investors coming into your deal and you had to deal with 70 of those and directly manage them, you probably wouldn't use crowdfunding. I would venture to guess. But if you have a platform aggregating those investors into a single SPV, managing them, doing the investor relations function, and bringing a $3 million check to you at the closing table with one wire, that's a much more manageable way to raise capital. So for us, it's always been about convenience to the operator. I do agree with Jillian that most investors haven't really brought up, the security, but I also think that's probably because they don't fully understand the security, some of them at least. But if we did it any other way, I think from a cost, scale, and convenience to our operator standpoint, it just wouldn't be a workable solution that could scale.
I want to also add to that end, personally, and I invest in a lot of crowdfunding. I put my money where my mouth is. I invest in a lot of crowdfunding platforms, and if you want to ask me outside which ones, I'll tell you. But personally, if you come to me and say, I'm going to give you a note with a deed of trust or a mortgage on it, and that's what you're going to invest in, I don't particularly care for that. As somebody in the know. And the reason why I don't particularly care for that is because that represents work for me. If you fail or that property fails, that means I have to get off my butt and go foreclose. I don't want to do any work. It's passive investment. Let's keep it that way. So I prefer the preferred equity or equity split model because then I know somebody's in charge to take care of that as a trustee or a manager for me.
And just looking at the history of crowdfunding, typically, as these businesses have grown and scaled, they become more and more dependent on wholesale financing or large funding sources, and those funding sources do care about the structure of the notes.
For sure.
Right? And certainly in a post-2008 environment where dislocations between the underlying security interest and the ultimate structure that folks were investing in caused a lot of problems. I'm wondering if you see any parallels or lessons learned that might apply to this.
Oh, well, when I did the remarks at the beginning, that's exactly what I'm talking about. We have to be abundantly cautious. We have to make sure that the investors know exactly what they're getting into. That all has to be disclosed, and we have to hold each other accountable for those things. So I don't know what particular platform you might be alluding to, but there is always a little bit of nervousness to me when, I don't want to say anymore. I'm going to stop right now.
I'll just chime in for a second. So I think what you mean is, are larger investors going to care about the structure?
Oh, well, they'll always care,
Family
yeah.
offices, institutions, is that what you're asking?
Yes.
So yes, of course. I mean, so when you think about the amount of capital one of those institutions is potentially deploying into your platform, it's in the hundreds of millions potentially. So to really get comfortable, and a lot of these larger institutions are warehousing the underlying security, so they need to get a Goldman Sachs comfortable with it as well. So they have to do a lot more diligence. But I don't think any platform out there is creating a structure that isn't workable for a large investor, because it still has elements that protect the underlying investor, even if it's one step removed from the asset level security. But there's going to be a lot more diligence there. But there's workable solutions, and we've seen it with large platforms that are outside the real estate space successfully execute it with institutional capital. So
Yeah, significant investments for institutional.
yeah.
There's a question back here.
Now, Dr. Swart, you mentioned that the acquisition cost of users is pretty high. Now, I'm curious, what has been your acquisition cost of an investor? And I'm curious also what you think it would be for a Reg A type offering for just, acquiring investors at $1,000 level type thing, like what Fundrise did.
So I don't think you can think of CAC or cost per customer acquisition in isolation. I think you need to think about it with respect to lifetime value. So lifetime value is how much is that customer worth, right? How long are they going to use the platform? How much revenue are they going to generate? And then you think about it in terms of payback period. So if you pay for a customer, what's that payback period? If your payback period is less than a year, then you're good. You're on the right track. So without giving you exact numbers, it's definitely higher to acquire. It costs more just on a pure CAC basis to acquire an accredited investor. And the reason is there's a lot less of them out there. So you have to really, depending on if you're doing a pay-per-click or if you're doing impressions, you're just going to get a lot less impression or clicks and signups. Because a lot of those investors will realize once they click on your ad that they're not accredited and they can't actually invest. So you just wasted a click on someone who's not a potential customer. But if you think about LTV and payback, the accredited investor has more liquidity, so they can invest more. So you're going to generate more income from that accredited investor because their average investment is $15K, where a non-accredited may be $1,000. So that LTV, my short answer is I don't know, because we haven't actually been marketing or trying to acquire non-accredited investors. And so we don't know what they eventually would invest and what their LTV would be. But generally speaking, we're acquiring accredited investors at a payback period that really makes sense for the business. The problem is there's just not a ton of them out there.
Nobody has the specific numbers on Title III yet. Our company's actually tracking all those transactions and trying to understand that. My guess is the CAC is going to be at least $100, $200 for the Reg CF guys. I mean, internet-based marketing for investor acquisition for crowdfunding is incredibly expensive and difficult and not very efficient, to put it mildly. Lots of firms are trying to figure it out, but those of you that are investors, we don't suffer from a shortage of investment opportunities, right? So it's not like people don't hit us with deals. It's not so much a matter of just randomly pinging people's LinkedIn profiles. I get about 10 a day investment requests through LinkedIn, literally, I'm not exaggerating that number. And I respond to 0, ever, in the history of LinkedIn, if I ever responded to one of those. It's about social networks. It's about breaking into networks of RIAs, breaking into networks of investors, breaking into existing syndicates, breaking into that. And that's something you can't use with Facebook.
Never mind.
We can argue later over drinks. So.
I don't have an argument. I had a question.
I think Reg A is higher. I don't know. I don't actually have specific numbers. I can tell you, like, this is an analogy. I've advised some of the largest marketplace lending platforms, and their customer acquisition costs can be north of $300.
I'll tell you this. When somebody comes to me to do a Reg A, I do not allow them to do that Reg A unless they have a current network of which to market to, or they have a budget for marketing. I don't care. They could say, I'll pay your legal fee. It doesn't do me any good and it doesn't do them any good and it doesn't do the industry any good to have a Reg A out there that's not working. So what we always try to do is work towards, all right, do you have a marketing budget or do you have a current network?
And just to give you some scales numbers, I'm not involved in any deals, but I've been tracking several of them. The ones that are being successful are spending 6 figures on marketing in addition to legal and compliance costs.
So my clients are not spending 6 figures on marketing.
And doing well.
And they're doing well, but this is why. A lot of them already have a massive mailing list.
Already built it.
So they've already built it, they've already invested the capital. I would say of the 10 that I'm working on right now, 9 of them have massive lists. So.
Hundreds of thousands?
They have at least in the tens of thousands. And some of them they're not all doing $50 million offerings either. I have some that are doing as small as $2 million and one that's doing small as $5 million. But they have this untapped market of a market that they've already created for themselves and the trust that they've already built amongst their investors. Oh, we're done? Oh, good. Wrapping it up. If you have any other questions, I'm sure we'll be able to answer them outside. Yeah.
Right.
Thank you.
Thank you.